Shanghai released a silver vault figure on Friday that genuinely stopped me in my tracks. And somehow, the market moved on like it was just another routine update. I honestly wasn't planning to record this. I was literally halfway out the door, phone in my hand, staring at the screen thinking, wait, did that actually just happen? Shoes on, keys ready. And I caught myself asking why no one was explaining what this really means. That's what frustrates me. The loudest headlines always give you the most convenient explanation, not the most accurate one. And you deserve better than that. So here we are. It's Sunday, February 8th in New York. Let me know in the comments where you're watching from and what day it is for you. Now let's set the stage, because what unfolded in China this week isn't just a China story. It's a plumbing story. It's a question of where the metal is physically sitting. And those kinds of stories have a habit of showing up right before markets embarrass a lot of confident people. I'll give you the punchline first, then we'll rewind. The amount of silver reported inside the main Shanghai Futures Exchange warehouse system dropped to just under 350 tons on Friday. And this wasn't a slow drift lower. This was one of those moments where you blink and the number changes, like someone pulled a tablecloth out from under a dinner setting. The day before, inventories were a little above 400 tons. That's roughly a 60-ton decline in about 24 hours. If your first reaction is, okay, warehouse numbers move, why should I care? Good. Keep that skepticism. One of the fastest ways to lose perspective in this market is to treat every inventory headline like the end of civilization. Sometimes it's real, sometimes it's accounting. The only way to tell the difference is to look at what else was happening at the same time. And here's what else was happening. The price being paid for silver inside China wasn't lining up with what the West was quoting. There was a clear gap. On quiet days, that gap might be a couple of dollars. On louder days, it stretches toward 10. But during the peak of the recent chaos, it pushed into territory that stops being a rounding error and starts demanding attention, more like $10 to $20, and in some cases even wider depending on the product. That's not trivia. That's the same market speaking in two different voices and disagreeing about value. And when that happens, history tells us one of two things usually comes next. Either demand cools and the gap collapses, or someone goes looking for metal. And that second path is where things start getting interesting. Before your imagination runs off toward secret tunnels packed with silver bars, let's talk about how this actually works in the real world. China has a massive metals futures market. This isn't some fringe venue. It's a major arena where manufacturers, traders, and funds all participate. And importantly, these contracts are physically deliverable. That matters because delivery turns the warehouse system into more than just a spreadsheet. It becomes part of the promise. In the West, a lot of silver ownership is indirect. Futures, ETFs, synthetic exposure, nothing inherently wrong with that, until too many people try to exit through the same door at the same time. China, both culturally and structurally, tends to place more emphasis on the physical side of the trade. Not perfectly, not always, but more than most Western markets. So when China starts paying up relative to the West, you have to ask the uncomfortable question. Is this a genuine pull on physical metal, or is it a distorted signal created by local market rules, taxes, and trading limits? And yes, those details matter far more than most people want to admit. Chinese markets operate with daily price limits on certain products. When price moves too quickly, it can literally hit a ceiling and stop. That traps traders. It can also create strange premiums and discounts that wouldn't exist in a fully free-floating market. Recently, that's exactly what we saw. Silver-linked products repeatedly slammed into daily limits. In at least one instance, trading was paused entirely because pricing became too disconnected. That's new, and it matters. Because it tells you this isn't just about fundamentals. You're watching market structure strain under pressure. Now bring your attention back to that warehouse number. A roughly 60-ton drawdown in a single day isn't something you casually shrug off. Even if part of it is administrative, it's still movement. Metal didn't vanish, it went somewhere. And if it went somewhere, someone wanted it somewhere else. So here's the question you should sit with. If this is all just speculative games, why is physical inventory being drained? Most speculative battles are paper battles. They involve leverage, margin, and clicking buttons. They don't require forklifts. That's why people are paying attention. And what really makes me lean forward is the speed. Warehouse reports don't usually change that fast unless something deliberate is happening. Either many participants are withdrawing metal, one very large participant is withdrawing a lot of metal, or the exchange is redefining what counts as in and out. That last point is important. Let me explain this in plain language. A warehouse number doesn't always mean metal is immediately available. Some inventory is registered for delivery, some is tied up. Sometimes the biggest swing is simply a change in classification, not trucks leaving the building. So yes, a record low figure is a warning light, but it's not a full diagnosis. It's one gauge on the dashboard. Here's why that nuance matters. If metal is being shifted from exchange warehouses into private storage, the market can feel tighter even if the country still has plenty of silver overall. That's not a shortage problem, that's a trust problem. And trust problems move markets faster than shortages. When manufacturers stop trusting that supply will be there when they need it, they stop optimizing. They start hoarding. They order earlier, they overorder. And that behavior is exactly how a normal market quietly turns into a stampede. Now layer a local premium on top of that. Premiums can come from demand, but they can also come from friction. Taxes, paperwork, financing costs, and the simple reality that most people can't arbitrage the gap. Seeing a $10 spread doesn't mean you can ship bars and print money overnight. Premiums act like a heat map. They show you where pressure is building, not necessarily why. That's why I hate the lazy take that says, China is paying more, therefore the world is out of silver. That's clickbait. Real markets don't work that way. But I also hate the opposite lazy take that says, it's just taxes, therefore it doesn't matter. Because when a premium sticks around, even if taxes play a role, it still changes incentives. It still affects where metal wants to sit. And it absolutely changes participant behavior. Now let's talk about volatility, because it's usually explained in the most shallow way possible. We saw a sharp drop, roughly mid-teens, followed by a rebound that looked respectable on the chart. People love to frame that as fear, relief, and then normality. The more interesting explanation is forced deleveraging. When markets are forced to delever, belief doesn't matter. Funding does. Margins rise. Cash gets demanded. Anyone who can't meet it gets pushed out. That happens everywhere, not just in China. And when it happens in a market that's already thin, price starts behaving like a heart monitor. Here's the detail most people miss. Forced deleveraging can actually tighten the physical market. It sounds backwards, but think it through. When paper longs get flushed out, headline prices fall. That attracts physical buyers who don't care about daily noise. Paper volume shrinks while real-world buying quietly increases. That's exactly how you can see inventories drop even while headlines scream crash. Now add another ingredient. Speculative fever across Asian metals markets, not just silver. Multiple contracts saw explosive participation, huge volumes, and retail-style behavior. When fresh money rushes in, price discovery gets sloppy. People chase, panic, and chase again. Under daily limit rules, that creates price cliffs, trading halts, positions get trapped. And that loops us back to the billionaire short narrative. In a market like this, a disciplined large short can make serious money and quickly become the villain when the crowd loses. So when I hear whispers about investigations, I don't immediately assume justice was served. I ask whether this is real enforcement or a pressure release valve for public frustration. Both are possible. If it's real enforcement, the impact can be immediate. Not because regulators wave a wand, but because risk managers adjust exposure. No one wants to be tomorrow's headline. If it's just a narrative outlet, the market may shrug and continue doing what it was already doing. We won't know which until behavior changes. Open interest, inventory, and premiums. Yes, open interest matters here. If positions collapse across the board, the market is de-risking. If positions stay elevated while inventories fall, risk is building, not disappearing. Now zoom out. Silver doesn't exist in isolation. It lives at the intersection of manufacturing cycles and financial cycles. When factories hum, silver demand rises. When solar deployment accelerates, silver gets pulled. Electronics, electrification, sensors, all pull silver. At the same time, when currencies wobble, rates confuse, and geopolitics heat up, silver gets pulled as a hard asset hedge. That's why silver behaves like two different creatures depending on the week. Sometimes it trades like an industrial input. Sometimes it trades like fear. Right now, it's being pulled in both directions. So what wins in China? If it's industrial demand, you'll see continued physical drawdowns and stubborn premiums. If it's speculative froth, premiums will collapse, warehouses refill, and the market goes quiet once the crowd gets burned. If it's both, you get the most frustrating outcome of all, chop, volatility, and sudden spikes that make everyone feel late. That's why the next week matters. If the Shanghai draw was a one-off shock, this cools down. If it's the beginning of a longer drain, the uncomfortable question becomes unavoidable. Where does the next bar come from? Let's make this practical. If you're a long-term physical holder, your first job is psychological. Don't get hypnotized by the quote. Understand why it's moving. If inventory is being drawn and the East is bidding, volatility is noise over signal. If this is speculative chaos inside limit-locked products, volatility is the story. If you're a trader, your job is position size. Silver doesn't reward ego, it rewards sleep. If you're staring at screens at 3 a.m., your size is wrong. One more subtle tell. Much of this activity looked retail-driven. When metal trades like a meme, you see inflows, product premiums, and sudden halts. Retail doesn't fake a story, or it amplifies it. So I'll leave you with two questions. Do you think this Shanghai stress is real industrial pull or speculative froth leaking into the warehouse system? And which signal matters more this week, the China West Premium or Vault inventory? Because boring data is where the real story hides. If you want more breakdowns like this, you know what to do. Subscribe so you don't miss the next update, because this story isn't finished. Educational only, not financial advice. Do your own research and make your own decisions.